Hey everyone, I wanted to do a quick video on yields and therefore bonds. So yields are what the bonds pay, the reward for people who buy the bonds. We're talking US. So the bonds are represented by the TLT, that's one of the bonds, and the TNX is the 10-year, represents the 10-year yield. So in this case, the 10-year yield is rising and thereby creating some scary thoughts for people. So people get uneasy when they move too fast in either direction, because I know on the way down people were saying, oh my god, yields are falling so fast, so badly. They have to catch a wind. And we traded this by catching the TLT rally. And here it is. This is rallying, meaning the TLT is falling. And this rally is pretty quick. Right, it's pretty sharp, pretty violent, but it has happened before, and it's not the end all. So the point of this today is to tell you mathematically there's no excuse me, I'm under the weather, I need to cough. There's no inverse correlation mathematically. Like if you tell a statistician, hey, there's an inverse correlation between price of the SPY and the price of the TNX, they would say no. In fact, if you overlay them, I just did it, I don't want to do it again. There are stretches where they move together and others where they don't. So it's not a reliable inverse relationship. Right now, sentiment makes it so, but it's not a rule. So I can tell you this. You can choose to believe it or not, but it's fact on the charts. So you can verify it. As to what do I see for that? So far we played, I charted them pretty well so far, and I'm going to share with you an update on that. So this is a daily with the line. These lines I just added, and I'll tell you. Up to here, all of these were old lines. So here's what I saw. Now I went back to 2020. When yields were down here, way lower than now, they fell apart. Remember during COVID? I mean, it was 50 cents, 0.5%. If you lent the government money, that's what the 10-year yield is. You lend the government 10 years money, and they'll reward you with 0.5%. Now it's 1.5%. But when they got here, I said there's an opportunity for it to get to here. And that was like a dream. Like, what are you talking about? And guess what? They struggled here because of this poke, but then they broke out and they never looked back. Right? They went to 1.7. And then that was March. And then they crashed, not too long ago. So that's why I'm seeing this rise here, and the news feeds, like everybody's freaking out, and I'm wondering why. I mean, we've seen this so many times. Look at this crash, and then look at this uncrash, and then they came back to, was this the COVID? Yeah. So they came back to COVID levels, the accident scene, and failed. Normal. Okay. So where's the opportunity now? First, I wouldn't panic in stocks. Like, how much less money is Apple going to make if the 10-year bonds pays 1.4 or 1.8% or 2.4%? Not much less. I use Apple as an example. This was a clear breakout, the target of which is somewhere around here. So here's what I added today. I added the opportunity for somebody that wants to trade this momentum continuing. Like if you want to short the TLT, meaning get long yields, get long the TNX. Another ETF that tracks the TNX is TBT. So the TLT and the TBT move against each other. TLT is when yields fall. TBT rallies when yields rally. Okay. The TNX does not have options. So if you want to trade the TNX via options, you're stuck shorting the TLT or using the TBT as a proxy. All right. So the easy statement is that this rally is fantastic for this ticker, and it's going into a prior fail zone. It is a zone, so you're going to have to pick your triggers. Depends on how you draw your lines. I'm a level guy, so I believe in this level breach rather than this trend breach. Look, this trend, if you want to draw it this way, some inverse head and shoulders, shoulder, head, shoulder. The upside potential is as big as this from here on up, so like 2.6. This could be the target right here. Potential target if it triggers. So potential target. Now I'm not talking fundamentals, I'm just talking charts. Forget what this is. This chart looks like if they take this red line out. So me, I would forego, if I'm not long and I want to take the red line breakout, I would wait a couple more ticks to see if it breaks out of the level. It's only a little difference between this yellow line and this red line. in this case, I would forego it. Personally, personal preference, I believe in level breakouts more so than trend level breakouts. This is a trend. I mean, you can draw that line any which way you want it. So where do you actually make the breakout? Like if I started up here, it would be steeper and the breakout would be down here. So I said there is a resistance zone right here. Excuse me 1 second. Okay, sorry about that. If it's taken out, then it could just spur enough to tackle the next level, which is 1.7, and the next level thereafter is the 1.77. Well, let's call it nice round number 1.8. Above that, there are levels that could make it fail, but they're far back that the momentum could make them burst right through. That's why I put a little jag. You know, they may burst, they may fail a little bit, and then the target should be up here somewhere. Now, I look left, and there are some potential pitfalls, so I have to pay attention to them. So how do I trade this? I think that the powers that be will fight the rising yield because so much money is owed everywhere, and last thing they want is runaway rates, and inflation becomes a much bigger problem. That's personal preference. Meanwhile, I just respect the charts. If I don't know the thesis of it, or I'm not sure, and nobody should be sure of anything, then we should respect the charts. Like this circle, that was perfect, and I didn't make it up. I looked left and I placed it, and look, they stuttered and then they took it out, they came back, tested my circle, and then now they're bouncing. So if they lose this one, they go back to here, but that's a highly improbable scenario. What's likely to happen is them stall and then maybe eventually break out of here in some slow-mo fashion, maybe by middle of next year. But what I don't do is I don't short stocks because this is breaking out, because I'm telling you there is no inverse relationship between stocks and this one. So I don't know what CNBC is saying. I don't watch CNBC anymore. So maybe in prior years when I used to watch it, I remember Art Cashin in 2018 was saying we had a hot jobs number on February 5th, I believe. It was a Friday. And the assumption was, oh my God, the Fed's going to hike rates, or the Fed's going to less QE. And markets corrected. Yields went flying, and the message was, Art Cashin was saying, not to pick on the dude, he's a nice guy, but the message from him is, if it hits 3, the world's going to stop rotating somewhere. And it did hit 3, and it exceeded 3, and then the second wave of selling, I think, was in April, and the message was, if it hits 3.25, then it failed just below 3.25. So we didn't have to find out whether the Earth was going to stop spinning. So this was the first scare, hitting 3, and then this was the second scare, hitting 3.25 almost. And the market corrected twice, and we didn't recover footing until Powell intervened and said, okay, I'm stopping the QT tightening and going back to QE, and he restarted buying assets, and that eased the pressure on everything. So the Fed intervened. So now the Fed intervened again by saying we're going to stop intervening eventually. That's the taper. So the taper message was so confusing. They officially didn't announce it, but then in the question and answer session, he not only announced it, he said when it would end. So if you're not announcing it, why on earth would you announce when it ends? Sneaky. So now he took out the mystery, took out the uncertainty, and dumped the fact that the Fed is maybe not our friend. But I say it's our friend because he's been saying that he could change his mind. So picture this. If things fall off the wheels, so to speak, like they did in October of 2018 and then finally capitulated in December of that year, they will change their mind. They will put the binky back in the mouth of that baby, the market. Or they will put the insulin back on the patient, the market. Whatever metaphor you want to use, they're not an unfriendly Fed. They're trying to delay raising rates to 2023. 2 people are leaving the Fed. They're both hawks. So now the Fed and the administration have the opportunity to bring in doves to replace them. I don't know if they can, but if they can, that makes them easier to. I don't know if they're voting members. I know one is a voting member that's leaving. I don't know if both are, Kaplan and Rosen something. So if indeed they're voting members, that's 2 raise rates votes out. Maybe they replace them to not raise rates next year. We don't know. So I wouldn't freak out. I still say markets will set a new high before we correct 20%. So for that, I have to still buy the dips in quality stocks and not assume the worst on every tick or every news bit out there.